Mute. Good morning, everybody. Looks like we're getting almost everybody in here. Had some technical difficulties. Sometimes WebEx isn't a huge fan of Chrome every once in a while, it seems. So I apologize if you had some issues getting in today, but welcome to the NPERS School Plan webinar. My name is Jeremy Calcara, and I'm the training specialist here at NPERS. And with me today is Heather Critchfield-Smith, the Education Services Manager at NPERS. Together we represent 2/3 of the NPERS Education Services team. And Heather will be talking to us during the second half of our webinar today. I did want to get started with just a little bit of housekeeping. Over here on the right-hand side of your panel, you'll see that there's a Q&A panel there available for you to use, and there's also a chat panel. We're going to ask that you would put all of your questions in that Q&A panel because the WebEx allows us to track which questions we've looked at and answered, and both Heather and I get both of those questions so that we can see who's asking stuff to make sure that your questions get answered. If you put it in the chat, it doesn't always go to all of the hosts, and we can't keep track of what's been answered and what hasn't on there. So if you do have a question, if you please put it in that Q&A panel and not use the chat, we would appreciate that. Next, in our brochure and materials that we sent you, we stated that attending a half-day webinar in conjunction with our Social Security, Medicare, and estate planning videos provides a full-day seminar experience. What does this mean? Well, what that means is what you're going to hear from Heather and I over the next few hours is a complete layout of your retirement plan. But our in-person seminar would also include a short presentation about Social Security, a presentation on Medicare, and a presentation from a licensed estate planner. So there's still some work you'll need to do to hear everything that you would have heard had you attended one of those. But the good news is we do have videos available on our website to cover each of these topics. A link to those videos was sent in your original registration email, as well as in the reminder email that I sent you just a few days ago. But I wanted to take a minute here to show you where those videos are on our website. Our website is that npers.ne.gov. And if you go to npers.ne.gov, you're going to see our homepage here, and if you click under Plan Info on School and go there, you're gonna scroll down and there'll be all of these videos for you to watch. This school pre-retirement video is a shortened version of what Heather and I are going to talk to you about today. So if you get done and decide, oh, you would like to review a little bit more, that's a good one for you to watch. The Retirement 101 video is basically an even shorter version of what Heather and I are going to give you today. Is a good refresher. You know, you get about a year down the line or something and you kind of forgot a lot of these things. That would be great. The Social Security video, this will give you just a short primer on Social Security. This is a video we updated in March with all of the new numbers for 2021 with Social Security. Of course, there are numbers and stuff that are changing every year. The cool thing about this one and attending a webinar is this video here is only about 28 minutes long. If you came to a seminar, you'd have to listen to us drone on about Social Security for about an hour. So just one of the reasons that it's a good idea to attend the webinar instead. And then we have a Welcome to Medicare video by our partners at SHIP, which is the Senior Health Information Program through the Nebraska Department of Insurance. So that gives you just a nice little beginning session about what Medicare is and what you can expect there. So highly recommend that if you need to know more about Medicare. And then we've created an estate planning video with a local estate planner from here in Lincoln, Ramsey Heineck, who does our Lincoln in in-person seminars, and just some basics about estate planning here that would be good for you to watch. And then also attached to that email that contained the link to today's webinar was a set of documents that will allow you to follow along with the information in our presentation today. If you don't have it pulled up, I wanted to show you really quickly where you could find it on that npers.ne.gov. It might be helpful to have open in a separate browser as we go through the presentation today. So if you come over here to under member info and you click on retirement seminars and you scroll all the way down to the bottom, there's going to be a little link here you can click. It says school pre-retirement webinar binder materials. And if you click on that, you're going to get our PowerPoint presentation and all of the information that we're going to be discussing today. So if you don't have that open, I definitely recommend it. The link to that is in the chat. Another good thing for you to have that you would have gotten one if you had come to the in-person seminar is if you go to here to your school plan info and you can click on member handbook. This is another thing it's helpful just to have access to. As we go through our chat today, we'll talk about some different things in here. So anyway, that's the website, npers.ne.gov. You are going to hear us talk about that website quite a bit today because there's just a lot of stuff on our website that we've created to help make things easier for you. So now that we've covered up that, let's just start to dig in here. First off, I did want to thank you for taking the opportunity to attend this WebEx session today. We created these webinars as an alternative to the in-person seminars just to serve our members better and give more opportunities to get this information out there. Our hope is that having this option, one that's free of charge and that you can attend in your pajamas and the comfort of your own home, is the one that you appreciate and enjoy. And man, today it's just a good day to not have to go outside and just get in that hot car and drive to an in-person seminar. I was thinking as I was at a softball game last night, and you know that smell that you get when you turn the furnace on for the first time, and there's always kind of that smell of like the dust burning off of whatever the pilot light or whatever that goes throughout the entire house. I just felt like the whole outside smelled like that yesterday. It was like the sun was burning off a layer of dust or something. Anyway, so hopefully you enjoy the option to sit at home and not have to go out today. At the end of this webinar, you will be directed to a short survey where you'll have the opportunity to give feedback about what you experience here today. We would greatly covet your responses to that survey so that we can just sharpen the sword with these and make sure we are covering the things that are important to you. And so yeah, when that pops up, please just take a minute and fill that out. It's not a very long survey, but it is very helpful to us. With that, we do have quite a few topics that we're going to cover today. We're going to talk about your plan design, how benefits are calculated, and then we're going to determine the options that members will have at retirement when filling out their paperwork. We're going to show you how to use our benefit estimator, and we're going to talk about the reemployment and application process. First, though, what is retirement? Here at NPERS, we like to say that retirement is when we stop living at work and begin to work at living. Our definition of retire is to begin a new, active, and involved chapter in life, starting new activities, and setting new goals. Our mission statement here at NPERS is the Nebraska Public Employees Retirement System recognizes the importance of a successful retirement and is dedicated to providing the highest quality service necessary to assist members in achieving this goal. In short, that just means we're here for you in this time. It can be a confusing time. It can be a time where there's just lots of decisions that need to be made. It can be a very stressful time, and we want to be here for you as you go and make these decisions about your retirement. With that in mind, this here is our contact information. This is the office that you'll want to contact when you're ready to apply for retirement. It's good to keep these numbers and this address handy. Why? Well, because we have your money, and in general, I like to know the names, addresses, and phone numbers of people who have my money. So we have our physical address there, our mailing address, and then our phone numbers, fax numbers, and web address. And those two phone numbers there, you're going to see there's going to be maybe some instances where we tell you you might have to call the call center today as we answer your questions. Those are the numbers there that you would want to call. And like I mentioned, our website has a lot of information on it for our plan members to assist you with your retirement. That's npers.ne.gov. The website also, it has all those videos on it that I showed you, your school handbook, the materials for this particular seminar. There's just a lot of information on there. There are newsletters, just things that we're constantly updating to make this step into retirement easier for you. The website also has the benefit estimator on it, which we will talk about here again in just a minute. And then another feature of the website that's really helpful, especially for school plan members, is the online account access. If you create an online account prior to retirement, you can see what we have on file for you as far as your service time. You can see what we have on file for you for your years of salary, and you can see who we have currently designated as beneficiaries prior to retirement. This is particularly important because of all the things we might tell you to call the call center for. One thing that they can't tell you is who you have designated as beneficiaries. So that online account access is a really good option if you want to know that information. A lot of things we're going to tell you today. Well, one thing we're going to mention more than once is that as you're deciding this, it's going to be important to, take out all of your retirement information onto a table and have discussions and to make these decisions. And the information that you can find by having that online access is going to be invaluable to you as you have discussions about retirement. So, and then another thing, once you do retire and begin receiving your benefit, there is some additional functionality with that online account access. You can change the amount of taxes that you're having withheld from your retirement, and you can also get your year-end tax statement there if you've created that online account. And then the benefit estimator is a tool that's available to you on our website so that you can get an idea of the kind of benefit you're looking at receiving when you retire. Heather has just put that over in the chat, a link to that benefit estimator. It's on the non-secure side of our site, so you do not need to log in to use that tool. You don't need to enter any sensitive personal information to use the tool, and none of the information that you do plug in is stored in any way. But here on the estimator, what you're going to do is you'll put in your date of birth, your anticipated termination date, and I want to take a minute and talk about that from here. You're going to hear Heather and I talk about two different dates when it comes to retirement a lot today. Those two dates are your effective date, which we'll talk about here in just a minute, and then your termination date. And when we say termination date, we are talking about the last day that you could be required to render services under your contract. So that's what we mean by when we say termination date. So you'll enter your anticipated termination date here on the estimator, and then you'll enter the date that you want your benefit to start. Then you're going to enter your date range when you started the plan, as there are 4 different tiers in your plan and different options based on which tier you're in. One thing that I do find helpful is that many of these fields have a pop-up help screen that will help define what it is you need to input if you're confused by what it's asking at all. But then you're going to enter either your 3 or 5 estimated highest annual salaries, and whether you have to enter 3 or 5 depends again on which tier you're in and which date you put for your start date. Then you'll put in your account balance. This is an optional thing that you have to put in. Because whether you might know this, you might not. Your account balance does not factor into the amount of benefit that you will receive every month. It does, however, come into play with some of their death benefit options that we'll talk about later this morning. So that's why it's asking for that account balance. But if you don't know it, if you don't have it, if you don't want to enter it, you do not have to. It just won't give you an option for the ones where your account balance will come into play. And then you're going to enter your beneficiary type. And then once you fill all of this in, you're going to get a list of options and links to where you can learn more about the options and an estimate of what you're looking at for a monthly amount. You'll see a lot of option 1, life only, option 2, modified cash refund. A lot of things there that you probably don't necessarily know what they mean. That's what the second half of our webinar is going to be about today. But this is just a quick primer on how to use the benefit estimator. Let's pause and take a quick drink here. All right, so how do you apply for retirement? What is the time frame you're looking at? This is something I'm finding that as we travel around the state, and so we've done um, a dozen and a half of these webinars or so, that a lot of people attend just to find out this information. So this is a very important slide. And the first thing that I do want you to know is that you don't have to do anything until you are ready to retire. So if you're 50 years old, you've got some service credit built up, but you're no longer with the school system, or you're going to retire at 60 but don't want to begin drawing a benefit, you don't need to contact us until you are ready to start getting that benefit check. I do want to take a minute here and talk about that second date I mentioned before, the effective date. Your effective date is the day that you want to begin drawing your benefit. Your effective date is established by contacting our office, filling out and sending in your application, and by ceasing employment for a Nebraska public school. So those are the two dates. The termination date, the final day that you could be um, required to render services under your contract, and then the effective date is the day that you want to begin drawing that benefit. So when you're ready, you'll want to call NPERS up to 6 months and no less than 1 month prior to your retirement. An office visit is not required to get this ball rolling. You do not need to drive into Lincoln and meet with somebody. A phone call is all that we need. We're then going to review your work history to verify your salary and your years of service. We will create an estimate of benefits, and your retirement packet will be mailed to you about 30 to 45 days prior to your effective date. Excuse me. You then need to complete and mail your application for retirement into NPERS. And for more information about this timeline, I would highly recommend reading our March school plan newsletter that you can find toward the bottom of that publications videos page on our website. Heather's also put it there in our chat. There's a really good article in there about what you're looking at with your time frames as you get ready to retire. So it used to be that people thought of retirement as like a three-legged stool. You would have your company's pension or retirement plan, your own personal savings from your investments, and then you had your Social Security. But over the years, we've seen people largely stop working for at the same place for their entire careers. So maybe their company pension doesn't get built up as much as we used to build them up. As a country, we've just gotten a lot worse at building up savings for several reasons. Things like inflation and wages not keeping up with inflation, etc. I know for me, it was because 15 years ago, my wife and I moved into a house that was only 6 blocks away from a Popeyes, and I still have a problem kind of driving by that place on my way home without getting myself a piece of, a 5-piece spicy tender dinner. So just a little pro tip there: if you go to Popeyes and they're going to ask you, you get that tender dinner, they're going to ask you what dipping sauce you want. You don't want any dipping sauce. You want mashed potatoes, and you want to dip it straight into there. So take it from this chubby guy here who knows and who has blown all of his savings at Popeyes. But anyway, for whatever reason, we just don't save like we used to. So what's happened is more and more, two of the legs on that stool have gotten smaller or disappeared altogether. And we see people putting a lot of faith in Social Security and maybe a little bit of luck to fund their retirement. And as that's and that's really a problem, just because Social Security is only designed to replace 35 to 40% of your income. So as that's happened, we're seeing people have to add outside earnings from a job to their retirement plans. And if that's something that you want to do, that's fantastic. You know, my mom has been an administrative assistant for most of my life. She currently does it for a living, but at times she's done it just on a volunteer basis for various nonprofits in the area. It's just something she really loves to do. And, you know, she's about 18 months from retiring now, and there's no doubt in my mind that when she retires, the next day she's going to go find a small business that needs some part-time office help, and she's going to work there because it makes her happy. And that's great. But what is just kind of bums us out is when we see people do that because they have to, when all you want to do is go fishing, all you want to do is knit, all you want to do is travel and see your grandkids, but unfortunately you find yourself having to add income. So that's just a reason that we like to do these seminars, and we just say that it's important to stay informed and take control of your retirement, because it does take more than luck to achieve financial security during retirement. Now, here on our school program, our school plan webinars, I do preach to the choir a little bit, because everyone here on this call who's a member has at least two pretty solid legs on that stool with Social Security and your defined benefit plan, which is designed to provide you with that lifetime monthly benefit. And as we go on here, it is important to note that what we're talking about is your money that no one else has access to. Bankruptcy or financial hardship can't touch this money. The only possible way that someone else gets access to your pension is in the event that you run into some trouble with the IRS or with a divorce. So if you keep the tax man and your spouse happy, you don't have to worry about this money not being there for you. This money is invested and available to you only when you quit or retire. It's your pension with no Social Security offset, meaning the amount of your benefit does not affect the amount of your Social Security payment, and the amount of your Social Security payment does not affect the amount of your benefit. All right, so with that, we're going to begin talking about the design of your plan. The type of plan that you have as a Nebraska Public School employee is called a defined benefit plan. And when you have a defined benefit plan, your retirement benefit is a lifetime monthly pension check. Like I mentioned before, your account balance is not important in determining the amount of that pension check. Instead, we look at a formula to calculate the monthly amount. The formula is determined by these factors, and the two biggest factors are your salary and your years of service. We're going to go through and talk about all of these and talk about how they affect your benefit calculation. Heather will speak in detail about the formula factor and option factor a little bit later. Um, But we do want to mention that the unicameral does occasionally make changes to the school retirement plans, and when it does that, this creates different tiers of benefits. So as we go through the presentation today, we're going to talk about how these have changed over time so you can determine which benefit tier you fall under and what your specific benefits are. Let's talk about funding here for a minute. Your plan is funded in four ways. First, it's funded by your contributions. That's that 9.78% of your gross salary that comes out of your paycheck. Your employer then matches your contribution at 101%, and then the state of Nebraska chips in 2% of your salary. This money is invested, and the majority of the funding for your plan comes from the returns on these investments. And as just a quick side note, as we go on here and talk about the formula, a couple of crucial pieces of that formula are your salary and the years of service. One great place that you can find that information is your annual statement that we mail out every summer. On that statement, you will find what we have on record for your compensation for the last year and your years of service credit. You will want to review that information for accuracy. I'm not saying that a school would ever give us incorrect information, but sometimes the schools give us incorrect information. So we want to make sure that what you have in your head is also what we have, or what your school's given to us. So if you see discrepancies between those two things, it's just a good idea to give us a call and iron that sort of thing out. Another thing you can do on this annual statement is find the beneficiaries and address that we have on file for you. So like I said before, you can't find your beneficiaries by calling and asking, but you can get them here on this annual statement, and those years of service and the salary, the compensation that we've gotten from your school. So check out that annual statement. Don't just throw it in a file when it comes. Make sure that it has all that correct information on it. And then we have to talk about taxes here for a little bit. Current contributions that you make to your plan are made pre-tax, but your contributions that were made prior to 1986 were made after taxes. Since you haven't been taxed on current contributions, you will have to pay taxes on your pension. However, anything that you put in pre-1986, those contributions will come back tax-free. And the method we use to return those contributions is called the safe harbor method. Here's how it works. It's not coming back in a lump sum. You're going to get a little bit back tax-free in each monthly check. How much is based on actuarial tables used to guess how long you will live. So let's refer here to the age of 55. If you had added $5,000 in pre-1986 contributions, that would be divided by 360 payments, and you'd receive $13.89 of each benefit check tax-free. Now, the money that you've contributed to the retirement plan and the money your employer has put in since 1986, those are pre-tax amounts. You haven't paid state or federal income tax on those contributions. That does mean that when you begin taking money out of your retirement, it is considered taxable income. Now, how are these taxes withheld? Well, these are basically withheld the same way that you have your taxes withheld right now, from your earnings. When you begin working for an employer, usually you will fill out a W-4, which tells them how much you want withheld from your paycheck. And then at the end of the year, your employer sends you a W-2, which you use to calculate the amount of taxes that you're either going to have to pay in, or if you had enough withheld, the amount of your refund. This will basically work the same way with your pension. In your retirement packet, there will be a tax withholding form where you tell us how much you want withheld for Nebraska and federal income tax from your monthly pension check. You can change that withholding at any time and will automatically withhold at that rate from every check. Now, if you do move to another state, you will need to contact the Department of Revenue for that state, because NPERS cannot withhold state taxes for any state other than the state of Nebraska. So if you were to move to Iowa for some reason, I don't know why you would, but people make bad decisions every day. You would want to call NPERS and say, hey, I moved to Iowa, and we would say, why? And you would say, I don't know, I'm sad. But regardless, I need you to stop taking those Nebraska taxes after or out of my check. And then you would want to call the Iowa Department of Revenue and say, hey, I moved to Iowa. And they would say, why? by? And you would say, I don't know, but regardless, I need to start paying you for this taxable benefit. Sorry, Iowa does take a little bit of a beating during my portion of the presentation, but I did spend all of last weekend on the eastern edge of Iowa, so I can tell you that it is like a post-apocalyptic wasteland out there, just like dead, like roadkill all over the road. We were just driving down I-80 and there's just a portion of the state that's just on fire. Anyway, don't move to Iowa. If you don't get anything else out of today, just don't move to Iowa. But anyway, so that's how that's important to do if you do move to another state. I know a lot of people once they retire will move to a different state, and so you'll want to make sure that you notify us so we don't continue to take those Nebraska income taxes out of your check. But anyway, then at the end of the year, Nebraska will send you a 1099-R. This is the form that's similar to that W-2 that you'll use to calculate the amount of your taxes. And then you'll see, will I get a refund this year because I had enough withheld? Or will I have to make a payment because I didn't have enough withheld? Excuse me, I'm having some allergy issues today. I don't usually pause and cough this much, but the pollen count, gotta love Nebraska. Anyway, it's better than Iowa. That's one thing I can say. If you don't like Nebraska, at least it's not Iowa. So let's go ahead and start digging into that formula that determines your benefit. The first component we're going to talk about is your salary. And this is one of those areas where which tier you're in matters. And you can tell which tier you are in by which date you entered into the plan. So if you joined the plan, meaning you became a member of the plan and started contributing before July 1st, 2013, you are in tier 1. If you joined on or after July 1st, 2013, but before July 1st, 2017, you are in tier 2. If you joined on or after July 1st, 2017, but before July 1st, 2018, you are in tier 3. And if you joined on or after July 1st, 2018, you are in tier 4. And if you fall under the original tier of benefits, we're going to look at your 3 highest 12-month periods to determine your benefit. And when we look at 12-month periods, the way we calculate this is we look at your final payroll date, and then we count back 12 months from that moment. So this would create your first 12-month period. And then we go back and we count back 12 months from there and 12 months from there until we create all of the 12-month periods in your entire work history. And then we take the 3 highest of those if you fall under tier 1. If you fall under tier 2 or tier 3 or 4, we take the 5 highest of those to create your average final salary and compensation. Now, when we talk about compensation, we do just like to go ahead. We get a lot of questions about what that actually means, and so we just like to go ahead and just read exactly from the manual what we mean when we say compensation. And you'll find that on page 15 of your plan handbook. Compensation means gross wages or salaries payable to the member for personal services performed during the plan year and includes overtime pay, member retirement contributions, retroactive salary payments paid pursuant to court order, arbitration or litigation and grievance settlements, and amounts contributed by the member to plans under State Statute 125, 403B, and 457 of the Internal Revenue Code. Compensation does not include fraudulently obtained amounts as determined by the Retirement Board, amounts for accrued unused sick leave or accrued unused vacation leave converted to cash payments, insurance premiums converted to cash payments, expense reimbursements, or per diems paid for expenses, fringe benefits or bonuses for services not actually rendered, including but not limited to early retirement inducements, cash awards, severance pay, and employer contributions for purposes of separation payments made at retirement. So that is what we mean when we say compensation. So we take all of those 12-month periods and we average the 3 highest or 5 highest to make that average final salary and compensation. It is important to note here that those don't have to be consecutive and they don't have to be the last years that you worked. We're going to take the 3 and 5 highest regardless of where they fall throughout your career. So I've had several people come up to me maybe who are getting up there and they're maybe in their early 60s, aren't quite ready to retire, but would maybe like to take a step back from teaching full-time to being maybe a part-time para or something like that, who have been worried about that affecting those those highest salaries because of their last years being less money than they've earned before. But that's not something you need to worry about. We pick the 3 or 5 highest, and just regardless of where they fall. Now, I do need to mention that increases in compensation are capped at 8% per year when calculating retirement benefits. For example, let's say in 2019, I made $50,000. And then maybe in 2020, I got a $5,000 raise to $55,000. Now, for me, that year, I saw a 10% salary increase in my take-home pay. That was nice. But for the purposes of benefit calculation, when we are calculating that final average salary and compensation, we have to cap that at 8%, which would be $54,000. So, but then maybe again this year I get another raise, but it's only $1,000, so my salary is $56,000. That's less than an 8% raise from the previous year's calculation of $54,000, so that cap would fall off the following year. So you stay in the plan long enough, it does go ahead, that cap does eventually come off, but it's something that's on there really to prevent people working just a lot of overtime their last few hours to just jack up their final average salary and compensation to sort of skew the formula. So that's why the 8% capping is in there. The next step is we're going to look at how many years of service you have accrued in the plan. Service time is granted for time worked while contributions were being made to the retirement plan. This service time is verified by your employer. If you decide to take a lump sum payment for unused sick leave, this does not count as service time or salary. If you took a refund, this erased service credit. We will talk about that here in a minute. Under the current statute, 1,000 hours of work creates 1 year of service credit. So that's something that has changed over the years. For instance, prior to 2002, the number of hours used to equal 1 service credit was 1,032, but it is now 1,000, and we will go ahead and use that in our example here, just because it's a round number, and I'm better at doing math with round numbers, and it's also the current rate. So once you've worked 1,000 hours, you have reached the maximum amount of service credit that you can receive for 1 year. If you work 10,000 hours, you get 1 year of service credit. If you work 1,000 hours, you get 1 year of service credits. That 1 year is the maximum you can receive for a July 1st through June 30th time period. But now let's say from July 1st to the end of June, you only had 500 hours if you're a part-time employee. If you're participating in the plan and contributing, you would still get partial service credit, and 500 hours would give you 1/2 year of service credit. So we're going to calculate all of the service credit you've accrued over your lifetime, and then we'll use that when we calculate the amount of your service. Now, in a few cases, it is possible you might get service credit for prior military service. That's something that's pretty rare, but you can find it explained in the manual on page 9 or in your seminar materials on page 11. As we just mentioned, if you previously quit work in the public school system and took a refund of your retirement account, your service credit was erased. If you return to work in the public school system, you do have the one-time option of repaying the refund and restoring the service credit provided you meet the following conditions. First, you must be a regular employee contributing to the plan. Second, your application for purchase of refunded service form must be received by NPERS within 5 years of reemployment and at least 60 days prior to termination. And finally, repayment must be completed within 5 years of reemployment or prior to termination, whichever is earlier. Service credit will be restored in proportion to the amount paid, and repaying this in full also potentially returns you to prior tier status. So maybe you were in tier 1, you left and you took that refund, you came back to the school system, you were in tier 2. There is the possibility that paying back that refund would put you back into tier 1. You do also have the option to purchase service credit. Why would you do this? For starters, the more service time you have, the higher your monthly benefit is going to be. It's just that simple. It's one of the biggest drivers in the amount of your lifetime monthly benefit check. Or maybe paying for a little extra time would allow you to meet the rule of 85, retire a little bit earlier. There are 3 ways that you may be able to purchase service credit. You can purchase service time for time missed during a leave of absence. For this option, you can purchase time equal to the leave up to 4 years. You can also purchase time for years spent working for an out-of-state public school system or for Omaha Public Schools. For this option, you can purchase time equal to the time you spent with that other system, up to 10 years. And you can also purchase up to 5 additional years of service credit in contemplation of retirement. Details about conditions you need to meet to make these purchases can be found on pages 14 and 15 of your seminar packet. We do have a new service credit estimator on our website where you can see how much it would cost to purchase service credit for out-of-state or OPS service, or in that 12-month pre-retirement service purchase. It's behind the school link under Plan Info. Heather has already put that in the chat as well. But if you open up the estimator, they're going to ask you what kind of service you want to purchase. They'll ask you your date of birth and then the date that you began participating in the plan. And then you'll put in your anticipated termination date with your anticipated start date for your benefit. And then on this page here, you'll enter your years of service and your highest 12-month period of salary. Here in our example, we have a member who is 55 years old with 27 years of service. Looks like to me like they were trying to figure out how much it would cost if they wanted to purchase the years it would take to reach the rule of 85. And here we do see that indeed they are looking to see how much it would cost to purchase 3 years and 0 months of service credit, which would put that member over the rule of 85. And we'll click next here after you put in how many years of service you want to purchase, and it's going to give you an estimate of what it would cost. And for this estimate that we ran, to purchase 3 extra years of service time would cost almost $56,000. Now that seems like a lot of money, and it is a lot of money. Personally, I don't have $56,000. If someone were to, lock me in a trunk and say you're not going to get out until you pay me $56,000, I would probably die in that trunk. But you have to remember that when you are purchasing service time, you're not only paying the portion that would have come out of your check during that time you're purchasing, you're also purchasing the employer match and the state of Nebraska match portions of that service time. So that's the school purchase of service estimator, and really that's just a really nice tool just to give you an idea of how much it would cost to buy a little bit of service time. So now we're going to talk about benefit eligibility. There are things that have to happen in order for you to begin receiving that lifetime monthly benefit. The first one, and this seems like it should be easy, but we have to talk about it a lot today because history would show that it is not, is you have to terminate employment at all participating employers. Heather is going to talk about that until she's blue in the face later, so I'm going to leave that to her. But then there's going to be 3 more things that you have to do to be eligible. Those are, yeah, is that you have to be vested in the plan, you need to attain retirement age, and you have to establish an effective date. So let's start with vesting. Most individuals will vest themselves by incurring 5 or more years of service credit in the plan. If you aren't vested and if you don't have enough service credit, you're only eligible for a refund, and that refund will not include the employer's match. Once you are vested in the plan, you're eligible to receive that lifetime monthly pension when you reach retirement age. And when we talk about retirement age, we're looking at your age on the effective date of your retirement. In other words, we don't look at the age when you quit working, we look at the age that you have attained when you begin drawing your benefit. And your age will determine whether you are eligible for a full unreduced benefit, or if you started early, if will be a benefit reduction. So let's begin by talking about the unreduced benefits. I do want to mention here that there are 2 ways that you can begin getting an unreduced benefit. A lot of people will conflate these 2 ways and think that they are one way, but I want to make sure and talk about them in specific terms so that you know the 2 specific ways that you can get that unreduced benefit. First, normal retirement age in your plan is 65. So once you attain the age of 65, if you've terminated employment and you're vested, you can begin drawing an unreduced lifetime benefit. Full stop. 65, you can retire. Your plan also has a provision called the Rule of 85 under tiers 1, 2, and 3. And the Rule of 85 states that once you attain the minimum age of 55, from that point on, if your age plus your total years of service credit equal 85 or greater, you can cease employment and begin drawing an unreduced retirement benefit at that age. So those are 2 different ways. Once you attain the age of 65, you can retire with an unreduced benefit, or if you meet that rule of 85. I have had people come up to me at seminars, and I had one lady in particular she was 71 years old, and she had something like 10 or 11 years of service credit, and you could just tell that she was ready to retire, but she thought that she had to work 4 more years until she met that rule of 85 to get that unreduced benefit. And so there were some tears of joy when I told her, no, you're above that retirement age. You can get that unreduced benefit beginning right now. So those are two different things. Earlier we talked about partial service credit, how and that's something that we use when we are calculating the rule of 85 along with your age. So say you are 55 and you only have 29 years of service, that only adds up to 84. Once you reach the age of 59 and a half and get that extra half a year of service in, so you would have 29 and a half years and be 55 and a half, we do count that as the rule, meeting the rule of 85. So that's another way where the partial service credit can come into play. But now, what if you are never going to meet the rule of 85? Maybe you're 60 and you only have 10 years of service credit, but you've decided that you're just ready to be done and you want to start getting that benefit. Nobody would blame you at all. But now you're not meeting that rule of 85 because 60 plus 10 only equals 70, and you haven't attained the normal retirement age of 65. But under your plan from ages 60 to 64, you can begin getting early benefits if you're vested in the plan and have terminated employment, but there is going to be a benefit reduction. And that reduction is 3% for every year that you're under the age of 65. So in our example, if that individual terminated employment at age 60 with 10 years of service credit, they would have a permanent 15% reduction in their lifetime benefit. Now let's look at the effective date. When should you apply for the benefit? An effective date is the date when your benefits begin, and you do have to submit your completed retirement application to establish an effective date. Your effective date will be the first of the month following the occurrence of these three things. First, you're eligible for benefits. Referring back to what we just talked about, that means you're vested in the plan and you've reached the age requirements. Secondly, you've terminated employment. And then thirdly, your completed retirement application is received in our office. Again, all three of these things have to occur, and then the first of the month following will be your effective date of retirement. You will usually see your first payment about 90 days following the effective date of retirement. That first payment, however, will be retroactive to the effective date. So if you receive your first check 90 days after your effective date of retirement, the first check would be for 3 months worth of benefit. Now, some school plan members may see a preliminary benefit. This isn't unusual, so if you see it on your paperwork that you're going to receive that preliminary benefit, there's no need to worry or panic about that. What we are doing in this situation is that we are still waiting on your final compensation and service credit information from your employer, but we want to try to begin getting money to you. We understand that everybody has a certain amount of time that they can go without receiving money, without receiving a check before they have to go selling a kidney. For me, it's about a week, week and a half tops, but hopefully for you all, it can be that 90 days when it's time to retire. But so we're waiting on that information and we want to start giving preliminary benefit payment to you. So and then once the school does finally provide us with the information that we need, we go ahead and recalculate your benefit to get you fully up to speed. And then the last thing I'm going to talk about here is the COLA. COLA stands for Cost of Living Adjustment. This is an annual adjustment that occurs with your plan each July, so it's automatically handled by the retirement office. You do not have to apply for it. The COLA is a benefit increase that's based on the annual change in the Consumer Price Index, which is the index that helps calculate inflation. So Tier 1 and Tiers 2, 3, and 4 have different COLA provisions. Under Tier 1, the maximum increase that you'd be eligible for is 2.5%. So let's say inflation is calculated at 1% using the CPI. That means that you'd be eligible for a 1% increase in your July check. But let's say that inflation was higher that year, maybe it was 5%. In that scenario, Tier 1 members would get the maximum of 2.5% for their increase. Now in that example, they have in theory lost 2.5% of their purchasing power. If we replaced 2.5% of a 5% inflation, that means that your dollar last year that was worth 100 pennies is now only worth 97.5 pennies. That's something that we track here in the office, and the state statute says that under Tier 1 you have to maintain at least 75% of your original purchasing power. So if at any time someone's loss of purchasing power reaches 25% or more, once that threshold is reached, that individual would get the full CPI increase, which in the example we just gave you would be a 5% increase in their benefit. That's how Tier 1 is handled. For Tiers 2, 3, and 4, the maximum cost of living increase is reduced from 1% from the 2.5%, and there is no 75% purchasing power provision under Tiers 2, 3, and 4. So that's the COLA, and again, that cost of living adjustment is there to help you retain your purchasing power throughout your retirement years. And with that, we have reached the end of the first half of our presentation, so I wanted to go ahead and see if we have any questions.
Okay, so we did get some questions there in the Q&A, but I answered most of them. For everyone's benefit, though, we will address this a little bit too, just so you know, people, if you missed it or whatever. Some of these were incredibly specific, just so you know, and so my answers might have seemed a little bit vague on them. And that is because the seminar experience is to offer you a broad overview of the plan and its mechanics. How it focuses on your specific situation is going to be entirely different from one person to the next, okay? So I can give you some general answers, but how it applies to you is something you might need to figure out on your own, or give a call to the call center for specific details, okay? Because I can't anticipate all the variables that might go into a situation, okay? And that's just upfront. I'm not a financial planner. So I'm not allowed to give you any kind of advisement too. First of all, we had somebody who asked, can you retire at age 60 and receive the NPERS retirement benefit if you have less than 20 years of service? Of course you can. There are some variables in there as far as you didn't give me your specific service credit or anything like that. So you do have to meet the vested requirement of 5 years or more. And that will be a reduced benefit if you choose to start taking it or making your effective date when you're age 60. Remember that Jeremy talked about the when you can do the reduced benefit, and that's 3% for every year that you're not 65, okay, as far as a reduction. So that's just something to keep in mind. You can terminate from your employment and then of course wait to receive your benefit if you'd like, and that will change the monthly amount as well. So there was that one. The next one we've got is about the benefit estimator. I'm going to let you handle this one, Jeremy. Why are there 3 salaries for the retirement calculator? Do you have to add all 3 or just the highest?
So you're going to put in your estimated 3 highest salaries there because, or your 5 highest, depending on which tier you are in, because those are the salaries we're going to use to determine your average final compensation as far as an estimate goes. I don't understand, I think, the question. So if you're in tier 1, you have to add those 3 because we use your 3 highest salaries, your 3 highest 12-month periods. And then if you are in tier 2, 3, or 4, you're going to add your 5 highest there because that's what we use when we calculate your final benefit is your 3 highest 12-month periods. So having that information is going to help you get a better estimate if you have it.
And what Jeremy means is that when he says add, you're going to get 3 boxes, and you want to
Yes.
put 1 annual
Yes.
salary per box. not add all three of them together and put them in one box. That's not going to help.
Yes. Okay.
We need the 3 separate years. So you don't add or the 3, 5 or the 5 highest years. Okay.
Yes.
So I hope that helps. Last one, and this is interesting one with regard to OS or OCS, and that is I worked in South Dakota for 7 years prior to working in Nebraska. I have 19 years in Nebraska. Can I add those 7 years from South Dakota as years worked, or is it just years worked in Nebraska when calculating the rule of 85? The South Dakota retirement money was moved into a retirement fund, but wondering about the years of working. Now, when you say retirement fund, this is what was vague and confusing to me, because if you've left those with the South Dakota teachers plan, whatever you have there, you might be able to buy that service. That's out of state service that you would be purchasing. And we talked about that. You can use the calculator to see how much that would be, by a certain year amount of it. But if you've already cashed out that plan in South Dakota, it's not like your years of service are sitting there. Anytime you refund out of a plan that has credible service as one of its requirements, that is going to wipe the service out. So that's just an important thing to note if you're planning on that. Um, if it's still in the teacher's plan in South Dakota and you're interested, I mean, write us a letter, say, hey, I'm interested in purchasing service credit. And the process can be started that way. So of course, you've got that first slide that we have in the presentation there that's got our contact information in it, with regard to that. But if you've already cashed that out, there's nothing to buy, just so you know.
And I did see someone here ask, why would you want to retire and not start drawing benefits? And that's just something that's you have to come on your own. Different people have different situations. One reason might be if you're 61 and you wanted to retire, but you don't want to take that benefit reduction, and so you're going to wait until you turn 65. But there's lots of reasons why that might be the case. Yeah, it's just depend. Everybody's situation is different. What makes sense for you might not make sense for somebody else. And then I had somebody in the chat here. Again, if you wouldn't use the chat for your questions, that'd be great. Use the Q&A panel, please. But somebody did ask, could you explain the Tier 1 COLA 75% purchasing power? And yes, I would love to explain that to you. Basically, that's just a provision that says that your benefit needs to maintain the 75% purchase, at least 75% of its purchasing power throughout the lifetime of you be getting your benefit. And so in order to do that, we track to make sure those years where maybe the inflation is over the maximum, we keep track of how much over the maximum it is and how it's not. And so then once you reach 25%, we go ahead and start giving you the full CPI if it were to be over that 2.5% to keep you above 75% of what your purchasing power was. I don't necessarily know that I explained it any more better there than I did when I was saying it, but if you wanted more clarification on that and which parts of it you wanted to know more about, you're welcome to put it into the Q&A area.
Okay, we've got another one. If I retire at 55, can I take 1 year off, go back to teaching in a public school for 5 more years, and draw retirement again? I realize it will be minimal. What you're talking about is something that we have a term for. We call it double dipping. Um, can you do it? Yes. Don't violate your reemployment protocols and processes on this at any point in time, but it is a possible thing and some people do it. So answer there, yes. Okay, so next, what is the best option if your rule of 85 is met in the middle of the school year? Well, the option really is up to you. I mean, you don't have to terminate employment. You can work till the end of the year if you'd like. If you're meeting the rule of 85, what that's giving you access to essentially is simply an unreduced benefit. You can take it at that point in time if you like, or not. Everybody needs to know how their finances are running and how the retirement plan is going to run in conjunction with their planning. If you don't have a plan about this, there's not much I can do to set you on a path. But if you're interested in something like that, I mean, just if you want to quit at the middle of the year, make sure you let the school know so that they can either write that into your contract, or work on you if you're an hourly employee to make sure that everything's taken care of. But that's about it that we've got for now. We're going to take a quick break. During that time, we are going to mute ourselves. We will be back in 10 minutes. So get up, get a drink, and then come right back because we're going to start on some really great things. We're going to talk about your options for benefit payments, and we're going to discuss reemployment and a couple other fun things like death. So there you go. We'll see you in a bit. We're going to take a 10-minute break. So make sure you return at, let's see, 9:36, so 9:46, please, and we'll see you then. Okay, everybody have a nice break? I hope so. Back with your coffee, back with your water. Um, Now you get to listen to me talk. My name is Heather Critchfield Smith, and I am the Education Services Manager for NPERS. I love to give these seminars and these webinars, mainly because I am very, very invested in this plan. Not necessarily in the fact that I get to participate in the school plan, I don't. But my grandmother was a special education teacher at Broken Bow for 43 years, and my mother also receives a pension benefit under this plan, both teachers. So near and dear to my heart, although I love everybody in this school. I like from the janitor, the lunch lady, the bus drivers, cafeteria people, administrators. It takes everybody to make a school run, and everybody is in the plan. We do focus sometimes a little bit on what teacher we might say teachers, but I know everybody's in here, and we're going to get you all retired. So if you have questions, make sure you're putting those in the Q&A. We didn't get anything during the break, so we're not going to start off with a Q&A, but we'll end with a Q&A again today, okay? So after I get done talking, we'll do questions again. We want to make sure everybody leaves here as educated as possible. So the first thing that I talk about while we leave this funny joke up on the screen is something rather important. It's something you need to pay attention to if you are getting close to age 70. And what that is an RMD. Now, a required minimum distribution, and we have a handout for that, which has just been put in the chat. If you're getting close to age 70, please open that up. A required minimum distribution essentially is the federal government taking a look at your beautiful 401A tax qualified retirement plan and going, hey, that is a really nice retirement plan. It would be a shame if someone were to tax it. So it's the government wanting to take their chunk out of your retirement plan for taxation, which is an okay thing. It's been growing tax-free for a while in that account. So they say that by a certain date and time, you, when you reach a certain age, must take a distribution from your retirement plan. Now, normally this is not a big deal, but the way the 401A defined benefit plan works is that you get a one-time distribution event. Okay? What does that mean? That means you get one time to take out the money from this plan to whatever you're doing with it, whether you refund, rollout, or take your lifetime benefit option. One chance, one time. Okay? Now, what that RMD does is simply puts you on the fast track. If you have reached your RMD ages, then you are on the fast track to make something happen with the distribution of your account. It simply kind of speeds your time frames up just a little bit. Okay, so if you are getting up at close to age 70, and that's not necessarily the ages for RMD, those have changed. If you were born on before July 1st, 1949, your RMD age remains 70 and a half. If you were born on or after July 1st, 1949, then your RMD age at this point in time is 72. Now, why do I stop and mention this? Well, the reason that I stop and mention this is because the consequences of missing those time frames for this retirement plan are pretty dire. Okay, essentially the IRS can charge you up to 50% of that RMD that you didn't take. And that's normally, if I'm giving you an estimate, around 4% of your account balance, all of it. So that could be a big deal. But the worst part about it is if you miss your time frames, your deadlines for your RMDs in the school plan, you can lose access to taking your lifetime monthly benefit. Now that's so important, I'm going to mention it again. If you miss your RMD time frames in the defined benefit plan, you may miss out on being able to take a lifetime benefit under this plan. And essentially, I mean, the lifetime benefit is one of the big deals about your DB plan. So if you're getting close, if you know someone who's getting close, to those RMDHs that I stated before, then you need to open up that handout that we just popped the link for into the chat and take a look at it. Now, I'm not trying to scare anybody, but you should be aware of these time frames and make sure that you're making sure that you're on top of those deadlines. Okay? All right. So let's move on to an actual slide. Here we go. This is my favorite part to talk about during these seminars, both in person and via the web. And I like both formats quite a bit, just so you know. And that is, I get to tell you about the benefit payment options for your lifetime monthly benefit payment. Now, if you take one thing away from this, just one thing from today, know that all of these options that we're going to talk about right now provide for you, the member, a lifetime monthly benefit payment. Okay, so you're going to, any of these options that you pick, any one of them that we're about to talk about, that's still going to get you, the member, a check in the mail every month for the rest of your life. Okay, there you go. Remember that. So with that in mind, what's the difference? You're going to, Heather, what is the difference with these then? Well, the difference is the probability that a death benefit will be paid under each option. Okay, that's different for each and every one of these. So the first one is always the easiest one to talk about. That is the life-only option. Now, the life-only option does exactly what it says it's going to do. It's going to provide you a monthly benefit payment check for your lifetime only. So you pick that option, you're going along, you're getting your monthly payment, and you pass away. There is no payment to a beneficiary. It simply ends. Okay? That's it. It simply ends. Now, the life-only option, because it has zero probability that we're going to pay to a beneficiary, that means that it is almost always the highest paying monthly option. So it's going to get you the highest monthly payment because there's no probability that we'll be paying any kind of beneficiary when you die. Okay? There's a lot of good reasons to take the life-only option if you enjoy that sort of thing. Some people who have all their debt paid off and have no real need for a beneficiary payment find this option to be very desirable. Or, you know, maybe you just need to have the highest amount monthly paid to you. This is also a good reason to take the life only. Now, I can't be sure or give you any kind of advice on that. There's a lot of different scenarios in which one of these options is going to be absolutely perfect for you, but some of the other ones may be awful for your financial situation. Knowing your financial big picture, what that looks like for you, is going to help you decide which of these options is going to best fit your lifestyle, your family, your situation. Okay? So let's move on to the next one. Essentially, with that life-only payment, at least one person comes up to me during the in-person seminars and says, Heather, I got to tell you about my friend. And I go, okay, well, tell me about your friend. And they say, well, my friend had worked for the school system for, 40 years, put into the school plan for 40 years, took the life-only option, got one payment in the mail, and they passed away. And that was it. Isn't that terrible? Isn't that awful? And I have to say, well, yes, that's very terrible. I'm very sorry for your friend. Those kind of things happen. Now, if you're kind of the individual who would lose sleep over that kind of scenario happening to you, the modified cash refund option might be a good pick. And the reason for that is the modified cash refund option provides a benefit to a beneficiary that works like this. You put in a bunch of contributions to the plan, right? Your contributions and interest are in the plan. You pick the modified cash, and when you pass away after receiving a certain amount of payments from the plan, we're going to pay the remainder of whatever you put in to your beneficiary. So a numbers example of this one are, let's say I put $60,000 into the plan, and I'm lucky enough to receive $10,000 in benefits. Hooray! But then I pass away. My beneficiary, whoever I have designated on file, would receive, in that scenario, approximately $50,000, because that's the remainder of the contributions and interest that I put in. Okay? And that's how that one works. Now, the next one we're going to talk about, the period certain and continuous, is a little bit different. People get confused by this option, mainly because it's associated with numbers. And those numbers are 5, 10, and 15 year. Now, we need to think about those time periods not necessarily as a 5, 10, or 15 year. We need to think about them in terms of monthly payments, monthly benefit payments. So for 5 years, that's 60 monthly payments. For 10 years, that's 120 monthly payments. And for 15 years, that's 180 monthly payments. And with this one, it's all about those payments. Like, my beneficiary is going to receive the remainder of payments for that period in which I die. Like if I'm if I have the 5-year period certain and continuous option, and I've received 12 payments, 12 monthly payments, 1 year of payments under that option, and I pass away, then the remainder of those payments, 48 monthly payments, will go to the beneficiary that I have designated on file. Now, let's say that I have the 5-year certain and continuous option, and I pass away in year 8. Is there going to be a beneficiary payout to my beneficiary that's designated on file? No, there's not, because I'm outside of that 60 payment period. Okay, so of course, as a beneficiary, which one do I want? Which one do I want my member to have? Well, the 15-year, because there's the highest probability of a beneficiary payout under that. And with that in mind, then we know that the 15-year is going to be a little bit less of a monthly payment to me, the member, than say the 5-year would be, because of that expanded possibility or probability of paying a death benefit out. Okay? Now, both the modified cash and the period certain and continuous options have what we call beneficiary flexibility. And beneficiary flexibility is going to be very, very important to some people, and it's going to be not important at all to others. What it is essentially is that you do have some flexibility with your beneficiaries. Like, let's say that you want to have a beneficiary who is a church or a charity as your beneficiary for these, which you can totally do. But you have to have that flexibility to do that. Let's say you want to have multiple people, like you want to have your 3 grandkids be your beneficiary or something like that. You have to have beneficiary flexibility in order to do that. And then, of course, last thing here, let's say that I want to change my beneficiaries after I have established my effective date and started my annuity payments. These two are the only ones under which you can change your beneficiaries after you establish that effective date. Okay? Which is why we call that beneficiary flexibility. That means we're going to go with whoever you have on your beneficiary designation form on file at the time. Okay? Okay. So we've looked at life only, no beneficiary, no payout. Modified cash and period certain with beneficiary flexibility. Let's look at an option now that does not have beneficiary flexibility. However, you do get one beneficiary. And the one beneficiary that you get under the joint survivor option is, anybody guessing? It's your spouse. But not just your spouse, it's your spouse that is married to you at the time you establish your effective date. And you know, if I said it that way, that it's kind of important, right? It's your spouse that you're married to at the time you establish your effective date. Okay, So let's say, for instance, I'm married to my husband, and I do the joint survivor option, and then he doesn't unload the dishwasher correctly, like usual, and I finally get that divorce. Do I get to change once I get remarried to a new beneficiary? No. It's locked into the spouse that you're married to at the time you establish that effective date. What happens if my husband predeceases me? I have a joint survivor option and he passes away before I do. Well, essentially what happens then is that you, the member, are going to receive, me, the member, would continue to receive my monthly lifetime benefit, but now there's no beneficiary to pay if they predecease me. It still ensures that I'm going to get that payment for the rest of my lifetime. It just doesn't have a beneficiary to pay should I pass away. Okay. Now, this one's also associated with some numbers, 50%, 75%, and 100%. And those numbers essentially are basically what your spouse is going to receive if you pass away. So let's say I, the member, I'm getting $1,000 a month in my monthly benefit, and I have a 75% joint survivor, and I pass away. That means that my spouse, who I'm married to at the time that I established my effective date, is going to receive $750 a month for the rest of his lifetime. Okay? So if you're pretty sure you're sticking with who you picked, then this might be a really great option for you. Maybe. Who knows? The percentages on here also, like the same way that the 5 to 15-year options do affect that monthly benefit, the percentages on the joint survivor also will affect the member's monthly payment. So if we're going to pay 100% to that spouse for the rest of their lifetime, that's going to be a little bit lower of a monthly benefit than, say, if we were only going to pay 50%. Okay, so that one does not have beneficiary flexibility. You're pretty much locked in. The minute you establish that effective date, you have one beneficiary. It is your spouse if you pick the joint survivor. Now, we have a non-spousal joint and survivor, and that one allows you to pick a beneficiary, but it is one human being, one living human being. Okay? It can be anybody, one living human being. And it's picked and you're locked in when you establish your effective date. Now with the non-spousal joint survivor, you can't pick a percentage. That one is only 50%. So whoever you pick as that beneficiary is going to receive 50% of your monthly benefit for the rest of their lifetime. One of the big things that can affect this is going to be the age of that one living human being that you pick. So I always have a lady comes up to me during one of the seminars we had a few years back. She said, Heather, I'm going to take that non-spousal joint survivor option. I think I'm going to put my granddaughter on there. And I said, well, you can totally do that. That's wonderful. And she said, I think, well, it was her birthday last week and she turned 19. Now, what do you think that attaching a 19-year-old or the probability that we'll have to pay a 50% monthly benefit to a 19-year-old for the rest of their lifetime is going to do to that member's monthly benefit? Well, I can tell you it's definitely going to bring it down a bit. The joint survivor options and the non-spousal, we take into consideration the age of the beneficiary that's being attached to those because of the non-flexibility with that. You're locked into that one beneficiary, then their age is actually used in calculation of your annuity. So that is something important to remember. And with that, I have one last thing about these. And it goes kind of along with that. You're locked into one beneficiary under JNS and non-spousal JNS, and that is when you get everything into us and you're starting your retirement process, okay, and you've got your application in, you should be almost finished, just about to establish your effective date. Once we have your application and you have established your effective date, you are locked in to that option, whatever you have chosen. So you can't come back in 2 years and be like, you know what? I know I picked the modified cash, but I don't really like that one. I'd like to change. No. Once you have established your effective date, you are locked into the option that you have chosen for your monthly benefit payment, okay? So it's very important that going into this, you know which one of these is going to be best for you. Now we know all of them are going to provide you with a lifetime monthly benefit payment, which is fantastic. These days, one of those things that we're trying to do with retirement is not outlive our money. And you wouldn't believe some people do have a problem with that. This is one of the ways that you don't have that issue. We're going to provide you with a monthly lifetime benefit. That's all the way through your lifetime. It runs almost like in conjunction with, let's say, Social Security that's going to pay you for your lifetime. So knowing, understanding these options and picking the one that's right for you is super important. With that in mind, we ran some estimates so you can kind of see what they look like in number form. Now, I'm a numbers person, honestly. It helps me to take a look at what I've got and see kind of what that amounts are going to be. I do like our benefit estimator on our website a whole bunch. And if you haven't messed around with that one yet, you should. So we took somebody who was a tier 1 member and gave them an average final salary of $35,000. And then we ran them through a couple different scenarios. The first one is an unreduced benefit, so it says normal on it, for somebody who is age 65 with 20 years of service credit. And you can see, of course, the life only is the highest monthly paying one. And then the modified cash. Now, on that estimator, we tell you that you put in your average salaries, those three highest or 5 highest there. But also there's a box that says account balance. And you'd wonder why we would want your account balance. Literally, it is only for this option. If you want an accurate benefit estimate for what the modified cash refund is going to be, that's when your account balance comes into play, right? Because that death benefit payout is your account balance minus any payments received, and that's what we're going to pay to your beneficiary. So that's why we need to know it. That's the only reason that it's asked for on the estimator. So if you don't care about this option, it's not going to be something you take. It's optional. You don't have to put it on there. But there you go. And then the period certain and continuous, of course, like I said, with that increased probability of a death benefit payout, that 15-year option is a little bit less monthly than the 5-year. Okay. The joint survivor, we made the calculations on this. Our spouse is the same age as we are. Okay. But you can see that with that increased benefit payment monthly to your spouse, that makes it a little less monthly for the member. And then, of course, we've got the non-spousal J&S annuity that we ran on here, and we made that person, our beneficiary, our one living human being, we made them 20 years younger in age, okay? So you can see what a big dip that is. 20 years younger in age really does affect that monthly amount, doesn't it? So the next set of estimates that we ran was for a reduced benefit. That's somebody who's claiming age 60 with 20 years of service. And you can see that that's kind of a big drop. Why is that a big drop? Because they're claiming at age 60. This one really illustrates kind of in a good way the reduction that you're going to take of 3% per year before age 65. So this person in the second column, essentially, if they terminated employment and decided not to take their benefit, like they terminated employment, but then they waited every single year closer to 65, they're going to get 3% more per year. So when we're looking at this middle column, that's a 15% reduction that you're seeing on there. Okay, that's kind of a big deal. And people, we had a question earlier, why would you wait? Well, some people wait because they want to make sure that they're going to get an unreduced benefit. I can't tell you if that's good for you or not, but there you go. The third one that we ran, of course, is our person who meets Rule of 85. So they're age 55 with 30 years of service credit. And oh my goodness, there is a big jump there between column 1 and column 3, right? Both of those are unreduced benefits. So what's the big difference there, people? If you're not shouting at the screen like Dora the Explorer, um, it's the service credit. It's that 10 extra years of service credit that we added on here that makes the big difference. And service credit does make a huge difference in the calculation of your benefit, which is why we ask to make sure that it is accurate. When you look at your annual statements, make sure that what you're getting on there is what you think you should be getting on there. And if it's not correct, contact us, contact your employer. We want to make sure that your benefit is calculated as accurately as possible so that you get the most out of this retirement plan. And honestly, you, the member, should be pretty focused on that too. So it's just one of those things that we like to give you a heads up and make sure that you're paying attention to, because you can see right there what a difference this makes, right? Okay. So choosing a payment option, a lot of different factors are going to go into your choice of your payment option. What's going to be best for you? What works for you? So we try and at this point in time, I try and get you thinking about that. Okay, because it's important. If you have a financial planner and you've got a plan and a roadmap in front of you, that's great. One of the first things you can do if you don't have that is attend one of these seminars. But we need to start having these conversations about retirement. We need to start paying attention to these factors that are going to be big deals. What's your health like? What's your family's health history? I mean, do you have a history of heart disease? Do all the men in your family die at 40? And you're the partial exception here? There's all sorts of different things. Do you have chronic conditions that run, genetic conditions that run in your family that might affect the when you claim things? Um, do you have a lot of debt? What's your debt to income ratio? Do you need to have something in place like a death benefit payout to a beneficiary to take care of that debt? Uh, do you have a lot of people that depend on you financially to get food in the fridge? Um, there's just so many different factors these days that are going to go into this, that if you're thinking about them, a lot of people, especially when we do Social Security, they say, why would somebody claim early? Well, you might claim early a reduced benefit of some sort, but think about this. If you have poor health and things like that, and you need that payment, you're getting 5 years extra, 5 years of payments that somebody who starts at 65 is not getting. Okay, there are good reasons for this. Let me tell you, I give two examples here. They're personal examples, but they help put things in perspective just a little bit on a couple different issues. Okay. Um, we have a lot of people that ask me questions about the modified cash refund app, modified cash refund option, a lot. And is that popular? Blah, blah, blah. Um, And that's because they're very concerned about getting out what they put into the plan. That option is there almost exactly for that. But I spoke a little earlier about my grandmother, right? Okay. My grandmother, she had 43 years of service credit at Broken Bow. And when she went to get her benefit, she put in approximately $28,000 to the plan and started claiming in the 80s. And she lived to be 97 years old. She got out of the plan something like 650,000 or over $650,000 in benefit payments. So you're going to be surprised how quickly your benefit payment option is going to overcome what you've put into this plan and help you to make it so that you don't outlive your money. Do you think she planned to be 97? I don't. Like, there was a point, I'm sure, that she just started living out of spite, but it was a good point. The second story that I tell about her is the fact that She didn't take the modified cash refund option. Her option that she picked was the 15-year certain and continuous. And the reason that she picked that at the time that she did was because she had 15 years left on the mortgage on the house. It was important to her that that debt be paid and that there would be a payout to cover that. So those monthly payments, had she passed away during that 15-year period, would have ensured the payoff of the house. There's a lot of different factors in this that people have to consider, okay? So with that said, of course, let's move on. What I want you to do, by the way, in order to really consider this, even if you don't have a financial planner, take out every piece of financial documentation you've got, put it on that kitchen table, put it on that breakfast bar, put it on that dining room table, and look at it. Know who your life insurance is through, know who the beneficiaries you have named on that life insurance policy are. Know about your health insurance, what you intend to do with that during your early retirement or during your retirement period in general. Are you going to be on Medicare? Do you need to find health insurance 55 to 65? That's a big consideration for a lot of retirees these days. So really look at that. Look at it, with your family. That's always a good opportunity to take the time. We need to be having these conversations. With that in mind, we're going to give you a little help on that. We want to make sure that you have ammunition when you're sitting at that table as far as what part of your salary is going to be replaced by things, right? Because we don't want to outlive our money. The ways that we do that are by looking at our lifetime income streams that we're going to have. Social Security in general is one of those lifetime income streams. And if you haven't been to the Social Security website, which is ssa.gov, they have a free estimator that you can use to basically estimate what your monthly Social Security benefit's going to be, depending on which age you claim of Social Security. But that'll give you an idea of how much is supposed to be replaced by Social Security, okay? Now, Social Security was only ever meant to replace 35 to 40% of your annual income, okay? 35 to 40%. Put that in perspective. I want you to think in a number about what you make a year. What's my annual salary? You got it in your mind? Now think about if you could live on 35% of that. Could you? Well, let's see. We know that we've got 35% coming from Social Security. How much is our retirement plan going to replace? So we've got this handy dandy chart, and we made this chart using essentially that 2% formula multiplier that's a static number in our calculation formula, okay? So Jeremy said he talked about creditable service and compensation. This is the formula factor that we were talking about in the formula for calculation of benefits. And then of course that annuity option factor is what we talked about with those benefits. Okay. So with that 2% static multiplier, I know, let's say my years of credit. I know my years of service credit, and I got 20 years. So about 20 years times 2%, that gives me a 40% salary replacement. So I'm going to add that to the 35% that I got coming from Social Security to give me approximately 75% salary replacement through the two things that I know I got, my pension plan and Social Security. That's not too shabby. But there's a couple people I know on the other side of this screen that just started sweating. So what can you do? You're getting close to the finish line. You're getting close to when you want to retire. What happens if you haven't saved enough? Well, you do have some alternatives. And this is the point in time where I normally just quickly go through that. You can look into, almost every school employer has what they call a 403B that they're running. And a 403B is simply another tax deferred retirement account that you can put money into if you'd like. Okay. The 403B, only like educators and certain nonprofits actually have access to participate in that. And it's got some great tax advantages, but it also allows you to have a place to put some extra or squirrel away some extra um, retirement funds. If you want to look into IRAs at this point in time, there's traditional and Roth IRAs, depending on what kind of tax strategy you have for retirement. And developing a tax strategy is going to be one of those things you need to start paying attention to now, because you want to keep the most amount of your money, right? So tax strategies can be invaluable in doing that. I don't advise on those, but we have you can contact a tax planner, a financial planner, an estate planner, and they do. With this in mind, of course, there are a lot of things that you can do, and getting close to that finish line, you're going to want to make sure that you're paying attention, putting some extra money away if you want to. And most of these accounts, just so you know, once you get over 50, the limits on what you can put into them increase. So that if you do kind of get a panic towards the end, you can drop in more than what you had been. So good thing to pay attention to. There we go. I'm going to take a little drink. Oh no, suspension of benefits. This is a scary slide that we put in here with a big scary title, so you'll pay attention to it. What it essentially means is that you need to keep your address up with us. We need to have that on file, and it needs to be current for a lot of different reasons, but I'm going to tell you, if we receive 2 pieces of returned mail as designated undeliverable or returned to the office, we're going to stop your benefit. And why would we do that? Everybody goes, why? Why would you do that, Heather? Well, the reason is it's a lot easier to suspend your benefit than it is to reclaim funds from beneficiaries once you have passed away. And we don't know what happened to you. So that's why we do that. Okay. Also, an important thing on this, we send you good stuff in the mail. We're not going to try and bother you with a lot of junk mail or anything like that. But in the summertime, we want to let you know about your COLA. Do you get a COLA increase this year? Do you want to know about that? Of course you do. And at the end of the year, when you file your taxes, we have to make sure we can get you a 1099-R so that you can actually do that. A little quick insider knowledge here. If you don't keep your address up with us and then decide that you haven't gotten your tax documentation because you didn't update your address, and you give a call into the office in January trying to get your 1099, we actually don't, we have to wait a month before we send a duplicate out on that, a whole month. And we all know that some of us need to have those taxes done for good reasons. So make sure you keep your address up with us, because we mandatorily we have to wait a month before we send out a second 1099. And that loss of time can be important to you. So just keep that updated. Okay. The next thing we're going to talk about, and I feel like I get all the really fun topics, like Jeremy gets to talk about neat things and I get to talk about not fun things. Let's start with reemployment. This is a topic that everybody squirms around during the presentation for. In order to receive a benefit from your retirement plan, you need to do one thing. Anybody guess what that one thing is? You have to stop working. One more time. You have to stop working at a Nebraska public school. Okay? And that one is super important, and not just important to us. It's important to the IRS, the federal tax code there. You have to quit. You have to terminate employment in order to start receiving pension benefits. Okay? And according to state statute, that means that you can't work for a school in Nebraska or anybody participating in the plan for a minimum of 180 calendar days. Okay. And why is that? Because everybody that participates in the plan, we're all in one big boat together. It's all the school plan. Got it? So teachers, employers, lunch ladies, administrators, all in the same boat in the same plan. Okay. And what do we mean by not provide any service? Well, it's paid service, voluntary service, part-time service, temporary service, seasonal service, all this service. Just don't. Okay? The important part to know here is because we're all in that one big boat, if somebody violates this, essentially what they're doing is not only bringing their retirement out of compliance with the standards that we need to be for tax qualified retirement plans, they bring the whole plan out of compliance. Okay? So not only are you jeopardizing your retirement, you're jeopardizing everyone else's. So this is important. Now, this normally gets worse, but do I have some good news for you? And this is the first time that I'm giving this part of the presentation this way. So in the webinar even, the slide does not match because this slide is literally brand new this week. Okay? If you need to write it down, if you need to start making notes, this is an important time to do it. We had some legislation that passed very recently. May 27th is the effective date for this one, and it's regarding substitute or voluntary service that you can provide during the 180 days. What? Yes, Nebraska has an exception for some substitute or voluntary service that can be provided during the 180-day period. When I just told you, you're not supposed to be working. Okay? This is particularly important because prior to this, we did not have any guidelines. We did not have any guidelines on what was acceptable as far as the amount of service, when you could do it, where you could do it, which is never a good answer. With this new legislation, which was LB 147, we did get some guidance. And basically the guidance is that service can be provided during that time on an intermittent basis. Okay? What does that mean? It's non-regular, intermittent basis. Think of it as sporadic, a little bit moved around, okay? For not more than 8 days of service in a calendar month. And then it goes on to define a day of service as any length of time. So that you can be going into the school for 5 minutes, or you can go in for a full 8 hours. One occurrence counts as 1 day of service. And you can't give more than, or you can't do more than 8 during that calendar month. Okay. Now, as usual, when we get rules, now I'm going to give you some things you can't do. You ready? You can't combine 8 days of subbing and 8 days of volunteer work. Why? Because 8 and 8 is 16. So you can do 4 days of subbing and 4 days of volunteering if you want. That is 8, but not more than 8. Got it? Okay. Also, you can't do 8 days of volunteering at school A and then go do 8 days of volunteering at school B. That's 16. It's got to be 8 days. Okay. Another thing, you cannot agree to train your replacement and use this 8 days of volunteering or subbing to come back and train your replacement. That is considered a pre-arrangement to return to service. And I'm going to talk about that one more in a minute, but don't do that. Another thing, refereeing, officiating, or coaching is considered regular employment. So you can't go back and use your 8 days to do any of those 3 things, refereeing, officiating, or coaching. Now, because this legislation is super new, we put out a handout on this. It's called the Frequently Asked Questions about LB 147's change to termination of employment rules. Why is it called that? Because we let our lawyer name the form. Ha 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 ha. It's always 15 words long if you let your attorney name your forms. So very important here, if you have questions about this, read through that FAQ document, which I believe will be in the chat in just a second here. And if you have questions after that, you contact our office. Okay, this is a very new policy. We want to make sure everybody understands it and can follow it. Okay. Now let's talk about pre-arrangements to return to service. What that is essentially is you're standing next to Coach Moore, and you turn to him and you say, you know what I'm going to do? I think I'm going to quit. I'm going to take my retirement benefit, but don't worry, I'll be back to coach track in the spring. No, no, no. That is essentially the definition of a prearranged return to employment. And that is any written or verbal agreement. And what it essentially, a lot of people do it so they can circumvent that 180 days they're not supposed to be working. Okay. It includes paid service, voluntary service, part-time service, temporary service, seasonal service, coaching. Do not prearrange to come back to service. Essentially, what that says to the IRS is, you know what? I didn't even really terminate. So it is very, very important that you don't do this in any way, shape, or form. Why don't you do this? Why don't you prearrange to come back to service? Well, let me just tell you, we are a state entity that essentially is audited all the time. We're audited by the APA. We have internal auditors. We are audited because we work with your money, which is a good thing. Audits help you be better at what you do. I don't mind them at all. Unfortunately, a lot of these cases for prearranged returns to service are found during audits. And because the consequences for prearrangement or no bona fide termination from service are a big deal, like you have to mandatorily repay any benefit amounts you've received. You have to pay them back in full. They could include interest, and they can be a potential garnishment of your assets. Okay. The reason being, this becomes an IRS tax debt. You can't bankrupt your way out of an IRS tax debt. The 3 cases that I know of that have been investigations in the past have not been for small amounts. They're not found like 3 months after you did it. It's found years and years into receiving benefit payments. So think about this: 350,000, 450,000, 600 or 760,000 is the third one. Now, in all 3 of these cases, I don't want you to get you riled up about it, there was documentation from the employer they did not have prearranged return to services. However, with that said, do I want anybody on this call to misunderstand what they can do during the 180 days or have a prearranged return to service during which these consequences become very real for them? No, I don't. So, and we did have a question on this earlier today. Now, if you want to terminate service with your, your school, and then go work for someplace outside of the Nebraska School Employers Plan or school plan, you can totally do that. Let's say you terminate at COZAD, but then you go work for Camp Kamika that summer. You could totally do that. That's a different employer. They do not participate in the plan. Okay. So if you wanted to stop employment and go work for a private company like Walmart or Target or wherever you wanted to be, you can do that. You just can't come back to an employer that is participating in the plan. And very often we get, Heather, how do I know these employers are in the plan? Well, let me tell you, the employer knows because they're paying contributions to us. So all you have to do is say, hey, do you participate in the Nebraska school plan, the NPERS retirement plan? They will know if they're paying us. Okay, so that's a good thing to ask. But let's say you get a year in and you suddenly look up and you're like, you know what? Crocheting is not for me. I'm just done. I don't like it. I think I'm going to go back to school. I like that a lot. That very pleased me. You can totally do that as long as you've paid attention to no prearrangement and outside of that 180 days. Okay, you're going to start a new account and you'd be a Tier 4 member, and your benefit payments would continue as regular. So, I mean, that's an option for you. That's never a bad thing. So you totally can. Now, much the way the legislature always tries to be helpful, they have added a new form to the things that we have to have before we can calculate your benefit. That form we lovingly call in the office the inducement form. There is a member inducement form and an employer inducement form. Okay. On those forms, basically you have to disclose if you had a prearranged return to service. And then the employer has to say if they had a prearranged return to service with you. Also, you have to put down if you had some kind of retirement inducement or early retirement incentive. Some schools do that, some schools don't. But if you do, you have to put that on your form. Now we have to receive the member form and the employer form completed before we're going to get your benefit done. Okay. So that's a state statute required thing. So make sure you're getting those in. Those are on our website. If either you or the employer are having problems finding them, most of the time they're with the packet and the employer has them. So just make sure you're filling them out correctly and indicating if you do have that prearranged return to service, which you shouldn't have. So I just told you not to do it. But we love talking to you. In fact, we like to talk to you most when things are not a crisis, if you can believe that. So if you have questions about this, the new legislation for 147, which you can find our handout on the website, of course, but also if you have questions regarding your personal situation, is this acceptable? Can I do this? Then give us a call. We'd much rather talk to you now and take care of this before it's a fire than work as your firefighters and help put it out later. We can be a lot less effective that way. So give us a call if you have any questions or if you want a situation reviewed. Enjoy this little joke that we put in here while I take a little drink. Okay, so we had a nice long discussion earlier about the monthly benefit payment options, right? And when we talked about that, we talked about the probability of death benefits being paid out, right? That is what you can do at retirement when you establish your effective date. What we're going to talk about right now is what happens before retirement, before you've established your effective date, okay? So let's say you have a bad tuna fish sandwich at lunch. This is death prior to retirement, okay? And this is kind of important because it's a little bit of a benefit that most people don't know about, okay? And what that is something called the Enhanced Spousal Benefits options. So if you pass away right now, you have 20 years of service or more, and you're age 65, then your spouse is going to have access to something like the 100% joint survivorship annuity. That's a big deal. Lifetime benefit under this plan for your spouse. Now, if you got 5 to 20 years of service, credible service, under 65, they have access to that 100% joint and survivorship option, or they can take a refund of your contributions and interest, wait, plus 101% of your account. So your account balance plus 101%. But in order to have access to these benefits, the enhanced spousal benefits, you have to have your spouse listed as your sole primary beneficiary on your beneficiary designation form that we have on file. And they're going to need to file within 120 days of your death. Okay. Now, if you got a non-spousal, somebody on there as a beneficiary is not your spouse, and you got less than 5 years of service credit, they're going to receive a lump sum payment of your contributions only. That's it. Sounds a lot less of a benefit than these enhanced spousal benefits, doesn't it? So if you want your spouse to have access to this, and some days my spouse deserves this, some days they don't, ha ha ha, then we have to make sure that they are on our file as our sole primary beneficiary. This shouldn't be difficult, but right now everybody's thinking to themselves, I wonder who I have on my account as a beneficiary. Sometimes those things get away from us. Like we start participation in the plan and then we work for the school for 30 years and we're like, I'm sure I filled one of those out a long time ago. It's got to be them. Um, so I'm going to tell you because I come from a processing background. I wasn't always the education service manager. I worked in processing for a long time, and part of what I did was death benefit payouts. I'm going to tell you at least once a year, we have a family that calls in and says, so and so passed away, and we need to get these started so that we can make sure that the funeral is paid for. And we put the phone down and say, okay, we're going to send out paperwork to the beneficiary who's on file. And we look to see who the beneficiary is on file. And it turns out to be the ex-spouse. Okay. Now, it's very funny that sometimes that happens. Do you think the ex-spouse is going to give that money back to the rest of the family? Well, who knows? Maybe they did, maybe they didn't. But if they're on there as the beneficiary, they're getting the death benefit payout on this. Okay. And I've had a number of experiences that were very sad, where families called and they cried and cried and they said, is there anything that you could do for us? And I had to say no. Once you have that kind of personal experience, you make sure that you tell people about this. You make sure that you um, put it to you that you need to be paying attention. And it's not just for ease of beneficiaries, it's to make sure the money goes where you want it to go. Okay? If you can do one thing for your beneficiaries, this is going to be a good one. So make sure that you know who you've got on there and exactly what they would receive. So with that, we're going to talk a little bit about beneficiary change forms. This is not going to be a huge amount, but the processors who get these in always ask us to make a little bit of a nudge here to anybody we talk to during the seminars, just to make sure that you know this is a notarized form, okay? Because we want to make sure it's your money. We want to make sure it's going where you would like it to go. So it's important that we establish you're the one that's making the change. That's why that form is notarized. When you're doing the notary on that, make sure that your signature date matches the notary date. You're supposed to be signing that in person in front of the notary. So those dates better match. I'm going to tell you that invalidates at least a fourth of the forms that we receive. So it's a very simple thing, but something you need to pay attention to. Now, if you want to find out where you can find your beneficiaries, who you currently have on file, there's some easy ways. If you have an annual statement handy, we worked really hard to get those beneficiaries listed on your annual statement. So check that out. They should be listed there. If there's nobody on file, then essentially maybe it's time for you to send in a new beneficiary designation. You can review it if you have an NPERS online account. You can go in and look to see who you have. You cannot change it online, but you can see who you have. Also, if you give a call to the call center on this one, they cannot give you your beneficiaries over the phone. So this is not something you could just call for, okay? So important to know where you can find those, and if you need to update it, just send in a new form. The best time to designate beneficiaries is now. And the second best time is, once a year when you sit down at that kitchen table and take a look at your finances, like you should be. So there you go. When we get that beneficiary designation form, you can put beneficiaries down like a trust or an estate. We just ask when you do that, let us know who to contact with that. If you have a trustee that we're going to need to get a hold of, put their name down, put their number, send in trust documentation so that we know what that looks like. If it's an estate, maybe list the PR and how to get a hold of them. That's always good to get this rolling and make sure the process is very fluid. Okay. Now, of course, we've got primary beneficiaries on this form. We've also got contingent beneficiaries. Now, a contingent beneficiary is not going to see a dime as long as there is a living primary beneficiary listed. So once all the primary beneficiaries, if they have passed away, then the contingent beneficiaries would receive an amount of the account, okay? But all the primaries have to be gone first. We have a lady in a seminar, what is it, 3 weeks ago? She had, and I love this one, 7 primary beneficiaries, and wait for it, 19 contingent beneficiaries. All 7 of those primary beneficiaries would need to be deceased before the 19 would see any kind of payout. And that's just an important thing to note. Now, if I want my spouse to have access to those enhanced spousal benefits, I'm going to list my spouse on one line. His name, spouse, social security number, date of birth, percentage 100%, because he is the sole primary beneficiary. Now, if I put my spouse on there and then I have one child and I put them both in the primary beneficiary section and put 75% to my spouse and 25% to the child, is my spouse going to have access to those enhanced spousal benefits? No, he will not, because he is not the sole primary beneficiary. So hopefully that's very important that you pay attention on that one. This form you can also use, you can see up in the demographic area, you can put a new address. So if you need to change your address, let's say you're a snowbird and you go to Arizona for 6 months out of the year, and you want to make sure that you're getting your mail out there and your residency is there. You can change your address using this form simply by putting that address on there. It's a notarized form, so then we could update it on the system if you wanted. There you go. You'll notice there's only about 5 lines here for primary beneficiaries. If you have extra, we have what's called the Beneficiary Designation Supplemental Form, and that one's got a whole multitude of other lines if you need more than that. Like I said, the lady I was talking about had 7, so 5 would be on the front and 2 would be on the back. You just have to make sure that the percentages equal 100. So if you have 3 beneficiaries, 2 of them are going to be 33.33%, and that third one is going to need to be 33.34%. They need to total 100%. So all the primaries total 100%. If you put contingents on there, all the contingents are going to need to total 100%. Okay? All right. The last thing that we're going to talk about here briefly, and I do mean briefly, is health insurance. And the reason that we're going to discuss this one anyway, I have to put it out here as kind of a disclaimer. We do not service any kind of health insurance at NPERS. It's not something that we take care of. It's not something, but I'm here to give you options because this is a seminar. So the options that you have right now. If you're age 50 to 65, you have one extra option that most people don't have, and that is the Educators Health Alliance and Blue Cross Blue Shield does a direct bill plan. You pay the full premiums on that plus fees. But if you're interested in that, go to the ehaplan.org/retiree-info. And that's going to give you a bunch of things about this program that are going to help you see if it's going to be something you want to do or not. Last year the video for this was an hour long, but I think they've slimmed it down to 27 minutes ish. And there's kind of a picture right there of what that video looks like from their website. So if you're interested in that, check it out. Okay. The next thing, we've got the Affordable Health Care Act on there, but there, you notice there's kind of a question mark. The reason there's a question mark on there is because I don't have a crystal ball. I don't know if this program is going to be around for the long haul. What's going on with that? Do I know retirees who have gotten on to the exchanges and purchased health insurance through them and really enjoy it? Yes, I do. But like I said, I can't guarantee that it's going to be around, so we don't talk about it too much. Another thing that we don't talk about too much is COBRA. You can get COBRA coverage, but most of the time that only lasts for about 18 months. And because this is like age 50 that we're talking about here, 18 months of coverage only is not going to do you too much good. We do talk about age 65 because once you hit 65, you're going to want to get a Medicare, maybe. With Medicare, we have partnered with a division of the Department of Insurance called the Senior Health Information Program, and they've done a really great video for us. They came up on the road with us as far as giving presentations to people about Medicare. But their video goes over a lot of stuff too. It'll define for you what Part A, Part B, Medicare supplements, Part D, and Medicare Advantage plans are. And then it also is going to give you some direction about Medicare fraud and things like that. These are important things to understand, as well as the time frames for making sure that you register for these. So there you go. I encourage you to watch this. It is really great. SHIP also does this thing where they're going to sit down with you and look at your drug plan coverage, all the medicines that you take, and then see which plan might be best for you. And they'll do those appointments virtually or in person, but it's a service they offer. So make sure you're taking advantage of all the things that are being offered to you as resources. Our website is a great place to be. We are constantly adding content to that thing, and it is never a static website. Right now, there's warnings all over the place about LB47, as well as our FAQ document, which you remember I mentioned during the reemployment talk. And with that mentioned and everything else, I think that's the end of me talking, at least for a little while. Do we have any questions on there, Jeremy?
We had a few questions that I've answered, but I did want to point out a couple of them because I was there's a couple that I was very proud of
Ooh,
people getting it. We get a lot of questions about the joint and survivor and the 15 or 10, 5, 10, 15 year stuff. Usually at seminars, and we had a question about one that I wanted to highlight because Christine says, is this correct? For periods certain and continuous, I get the benefit as long as I live, regardless if I select 5, 10, or 15-year options. Those designations only relate to if a designated beneficiary will receive anything once I pass. So
yes.
it's so rare that I think that that's super clear the first time, so I wanted to point that out. Good job, Christine. That's 100% accurate. And then Candy asked sort of similar. So if I choose a 10-year and I die at 12 years after the effective date, the beneficiary doesn't get any money. That is correct. You're doing, yes, very good. So um
Oh, important thing to note, and that's because, we talked about the period certain, but it's the same thing with modified cash. Let's say that you put in $60,000 of contributions. You remember what the beneficiary payout is on that one. It's contributions minus the benefits you receive equals what we're paying to the beneficiary. So if you put in $60,000 and then receive $80,000 in benefits, is there a payout to your beneficiary? No, there is not.
all right, and then other than that, we've had a few questions that have already been answered. So that is actually all that we have for our webinar today. So if you have no more questions and all of your questions are answered, you are free to log off and have a little extra time with your day this morning. We would ask if you would take a few minutes to fill out that survey. That would be very nice. We would appreciate that a lot. If you do have questions, though, we will stick around here and answer as long as they are coming in. So again, if you don't have questions, thank you for coming. And then if you do, get them in there. We'd be happy to answer. To see people kind of starting to sign off. We haven't gotten any questions yet. Joyce says, thank you. This is very informative. Have a great day. Thank you for coming, Joyce. We love to have people come to these and hope they're helpful. So thank you. Let me see. Someone asked, can you tell us which benefit payment option is chosen the most?
Haha, that's very funny. We always get people to ask this question, and I can tell you that the one that is picked most often by people, not that it should be applied to your situation simply because you want to go with what everybody else does, it's modified cash. The modified cash refund is that one where it's the contributions you put in minus benefits received. That's a payment to your beneficiary. And that is kind of the most popular, or life only. Life only is about the second most popular as well. Um, but it really is, it's a personal choice and everybody is different.
And Cindy says, thanks for the information. Second time definitely makes information make more sense. Went to a meeting 3-4 years ago. Where do I find the survey? Cindy, as you sign out, it should pop up for you. So you wouldn't see it as long as you are still signed in. I do see we're down to about a third of what we started with, so people seem to be signing off. But again, if you have questions, we'll hang out here for a few more minutes. Be happy to answer them for you. If not, thank you again for coming. Okay, Dell says, I still love my job and have no plans to retire soon. I'm 57 with 35 years of service. Are there any problems with continuing to work until 65 or 70? As long as I avoid the RMD, as long as I begin receiving distributions before 72. No, not at all. The more you work, the more the more service time you can accrue, the more your benefit is going to be. And obviously, if you keep getting higher salaries, that's going to increase. So, you know, there's there's a difference between no penalty for stop working like we get sometimes, or for stopping to work like you get at age 65 or the rule of 85, and with there being no benefits to it. There are definitely benefits to continuing,
Heck yeah.
if there's not a penalty for not continuing. So. Somebody says, I like seeing the Maneki Nico Lucky Cat in Heather's
Haha.
background. I have one in my office too.
I need all the luck I can get. He waves his arm, but I don't have him plugged in.
I know when I first started, I thought she stole it from a Chinese restaurant or something, but she says she purchased it.
Most restaurants don't have as nice a cat as I've got.
Oh, okay. Adele says, very helpful. Thank you both. Well done. We appreciate it, Adele.
Thank you.
All right, I don't see any more questions in. Looks like people are kind of leaving, so we will go ahead and call it. Thank you again for coming. Please fill out that survey and just have a good rest of your Wednesday and try and stay cool out there. Have a
Thank
good day.
you.
Do, do, do.